Basic mistakes for people starting to invest money. Mistake number 7. Neglecting regular review. Mistake: setting and forgetting your investment portfolio. Impact: missing opportunities for rebalancing or adjusting to changing market conditions. Solution: regularly review your portfolio considering economic changes and adjust your strategy accordingly. Without regular reviews, investment portfolios may become stagnant, holding assets that are no longer aligned with the investor's objectives or market conditions. Market dynamics and economic conditions change over time. Neglecting to review and update a portfolio may result in missed opportunities to capitalize on emerging trends or adjust to market shifts. Financial markets are dynamic and risks evolve. A neglected portfolio may become overexposed to certain risks or fail to adapt to changing market conditions, potentially increasing vulnerability to losses. As financial goals evolve, so should asset allocation. Neglecting regular reviews can lead to inefficient asset allocation, where the distribution of investments no longer aligns with the investor's risk tolerance and objectives. How to address neglecting regular review. Set a regular schedule for portfolio reviews. This could be quarterly, semi-annually, or annually, depending on individual preferences and market conditions. Periodically reassess financial goals and objectives. Changes in life circumstances, risk tolerance, or time horizon may necessitate adjustments to the investment strategy. Stay informed about market trends, economic indicators, and geopolitical events. Regularly assess how these factors may impact the performance of different asset classes. If market movements have caused deviations from the target asset allocation, consider rebalancing the portfolio. This involves buying or selling assets to restore the desired balance. Periodically review the fees and expenses associated with investment holdings. Assess whether the costs are justified, and if alternative, lower cost options are available. Continuously educate yourself about financial markets and investment strategies. A well-informed investor is better equipped to make sound decisions during portfolio reviews. By incorporating regular reviews into the investment process, investors can adapt to changing circumstances, seize new opportunities, and ensure that their portfolios remain aligned with their financial objectives. Regular monitoring is a proactive strategy for building and maintaining a resilient investment portfolio. Mistake number 8. Lack of research. Mistake: investing in assets without understanding their underlying fundamentals. Impact: exposure to unnecessary risk due to insufficient knowledge. Solution: conduct thorough research or seek advice from financial professionals before making investment decisions. Without proper research, investors may make decisions based on incomplete information or market rumors. This can result in poor investment choices that do not align with the investor's financial goals. Research is a key tool for risk management. Lack of research can expose investors to higher levels of risk as they may not fully comprehend the potential challenges and uncertainties associated with their investments. Thorough research enables investors to identify potential opportunities in the market. Without it, investors may overlook lucrative prospects and fail to capitalize on favorable conditions. Proper research is essential for constructing a well-balanced and diversified portfolio. Investors who neglect research may end up with an inefficient asset allocation that does not align with their risk tolerance or investment objectives. How to address lack of research? Take the time to educate yourself about the basics of investing, financial markets, and the specific assets you are interested in. Knowledge is a powerful tool for making informed decisions. For stocks and other securities, perform fundamental analysis. This involves examining a company's financial health, earnings potential, management team, and industry trends to make informed investment decisions. Regularly update your knowledge about market trends, economic indicators, and global events that may impact your investments. Staying informed allows you to adapt to changing market conditions. Explore a variety of information sources, including financial news, research reports, and expert analyses. Diversifying your research helps you gain a well-rounded understanding of the market. Leverage analytical tools and financial metrics to evaluate the performance and potential risks of your investments. Tools like financial ratios, valuation metrics, and technical analysis can provide valuable insights. If needed, seek advice from financial professionals or advisors. They can offer expertise and guidance, especially for complex investment products or strategies. By addressing the lack of research, investors can make more informed decisions, reduce risks, and enhance the overall performance of their investment portfolios. Research is a fundamental aspect of successful investing, providing the knowledge needed to navigate the complexities of financial markets. Mistake number 9. Borrowing to invest. Mistake: using borrowed money for investments. Impact: magnifying losses and increasing financial risk. Solution: avoid leveraging investments unless you fully understand the risks and have a robust risk management strategy. Borrowing to invest, also known as leveraging, is a mistake where investors use borrowed money to amplify their investment positions. While leveraging can magnify returns in a rising market, it also significantly increases the level of risk and can lead to substantial losses. Using borrowed funds amplifies both gains and losses. If the market moves against the investor, losses can be magnified, potentially resulting in a significant financial setback. Borrowing comes with interest costs. Investors must repay not only the principal amount but also the interest on the borrowed funds. This can eat into potential returns and reduce overall profitability. When the value of the invested assets falls below a certain level, brokers may issue margin calls, requiring the investor to deposit additional funds to cover losses. Failure to meet margin calls can lead to forced selling of assets at unfavorable prices. Borrowing to invest reduces financial flexibility. Investors are committed to repaying borrowed funds regardless of market conditions, limiting their ability to adapt to changing circumstances. In volatile markets, leveraging can lead to heightened stress. Rapid and unpredictable market movements can result in significant financial pressure, especially if the borrowed funds need to be repaid during a downturn. How to address borrowing to invest? Before considering leveraging, thoroughly understand the risks involved. Recognize that while it can amplify gains, it equally amplifies losses, and market fluctuations can have a significant impact on borrowed funds. Consider your risk tolerance and financial capacity to handle potential losses. Leverage is not suitable for everyone, and investors should only take on levels of debt that align with their risk appetite. Diversification is a key risk management strategy. Instead of concentrating borrowed funds in a single investment, spread the risk across a diversified portfolio to mitigate the impact of poor performance in any single asset. Before borrowing, establish a clear repayment plan. Understand how the borrowed funds will be repaid, including the interest costs. Having a well-thought-out plan can help manage the financial commitment. Using borrowed funds for highly speculative or volatile investments increases the level of risk. Consider more conservative investments when leveraging, and avoid overly speculative bets that can lead to substantial losses. Keep a close eye on the performance of the leveraged investments. Regularly monitoring positions allows investors to react to changing market conditions and adjust their strategy if necessary. Borrowing to invest is a strategy that requires careful consideration and a deep understanding of the associated risks. While it has the potential to enhance returns, investors should approach leveraging with caution and ensure that it aligns with their overall financial goals and risk tolerance. Mistake number 10. Falling for get-rich-quick schemes. One of the common mistakes made by investors is succumbing to the allure of get-rich-quick schemes. These schemes promise rapid wealth accumulation with minimal effort, often leading investors into fraudulent or high-risk ventures. Many get-rich-quick schemes turn out to be scams, resulting in significant financial losses for investors. These schemes often prey on individuals seeking quick profits without considering the associated risks. Involvement in fraudulent or illegitimate schemes can lead to legal consequences. Investors may face legal actions, fines, or even imprisonment if they unknowingly participate in activities that violate financial regulations. Falling for such schemes can damage an investor's reputation, especially if they promote or endorse the scheme to others. This can impact relationships with family, friends, and colleagues who may have been influenced by the investor's actions. Investors who fall for get-rich-quick schemes often neglect proper due diligence. Failing to thoroughly research and understand an investment opportunity increases the likelihood of financial exploitation. Financial losses and the realization of being deceived can cause significant emotional distress. Investors may experience stress, anxiety, and a sense of betrayal, affecting their overall well-being. How to avoid falling for get-rich-quick schemes. Approach investment opportunities with a healthy dose of skepticism, especially if they promise unusually high returns with little or no risk. If it sounds too good to be true, it probably is. Before investing, conduct thorough research on the investment opportunity, the company, and the people involved. Verify the legitimacy of the scheme and seek independent reviews or expert opinions. Every investment carries some level of risk. Understand the risks associated with an investment and be cautious of schemes that downplay or ignore these risks. Seek advice from financial professionals, such as certified financial planners or investment advisors, who can provide objective insights and guide you toward legitimate investment opportunities. Avoid putting all your funds into a single investment. Diversifying your portfolio across different asset classes can help mitigate risks and prevent substantial losses from a single investment failure. Stay informed about investment principles, financial markets, and common investment scams. Education is a powerful tool in protecting yourself from fraudulent schemes. Remember, genuine wealth accumulation is a gradual process that requires patience, diligence, and informed decision-making. By avoiding the allure of get-rich-quick schemes, investors can protect their financial well-being and make more prudent investment choices.